Yeah, welcome, Iba. I'm just going to give 30 seconds or 1 minute for the others to join up. If they are not up, I would continue with the class. I would continue with the class. Iba, I can. Okay, Iba is on. Iba, please confirm you can hear me. Just say okay if you can hear me so I can start the class. If it's just you, no other. Iba, can you hear me? Very good. Let's start the class. Okay. Let's hope the other ones join us. But for now, let's start. We're kicking off with welcome to KRABmist Tutors. My name is Stanley Amechi. Welcome to KRABmist Tutors. My name is Stanley Amechi, like you know. And I have 8 classes for this session on financial reporting. I can hear, thank you. I'll try to stop the bad habit. So, financial reporting. What's financial reporting? I've heard you, but let's continue. What's financial reporting? This is like, it normally used to be called F7 before now, the short acronym for it. And we'll go through your syllabus. I'm sure you should go through your syllabus to know. Who else is there? Please confirm. Somebody joined and went off. Oh well, we'll still continue. Now your exam would be characterized with 15 MCQ questions, and we also have like 5 case scenarios. 15 MCQ questions, that's 2 marks. Easy to make 30 marks. Easy to make 30 marks. Ijoma, it's not opening in my system. Why is it not opening in your system? But it's not opening in your system. Okay, we'll fix that. But Ijoma, confirm you can hear me, please. Ijoma, just say okay if you can hear me. Oh, well, let's continue. Now, okay, Ijoma, don't worry, See, use what you have. After that, I will send this video down to you. This video is free for you guys. It's not a problem. But just confirm that you can go with this class right now. Thank you very much for confirming. Okay, financial reporting. It used to be called F7. Generally, we have, for you to generate a report, before we're talking about the report, we're talking about the structure of the exam. You have 15 MCQ questions, 2 marks for those questions, and that's 30. 15 mark questions, that's 2 marks, 30. 5 scenario questions, and also 2 questions, which is about 20 marks. 5 scenario questions, 10 marks, 50, 1 question or so. So generally this is your 100, and you have to, the pass mark is 50. Once you score 50, you have passed it. So the game plan we have is to attack this, especially this. This will be easy for you to get, and this other one. So let's go straight to the crux of the matter. So I'm sure you have your LSBF March 2017 opened up on your system. And we will go straight, it's structured for financial reporting. What it does is, they actually IAS, it's called IAS. IAS and IFRS. Now, these are principles which you use to build up the numbers in the account. You have to have a way to recognize transactions and events that happen and also measure them. So you can't just say that your statement of financial position, that you just put any figure there. No. They have different IAS in the International Accounting Standards, that's for that. International Financial Reporting Standards, they have different ones. They have IAS 2, they have IAS 16, property, plant and equipment, and that is the crux of what we are going to do in this session in terms of financial reporting. But first of all, we are going to look at the approach we are going to do now is at first consolidation of financial report, because in the 20-mark questions, it's either going to be consolidation of the statement of financial position or consolidation of the profit and loss. Now, what is the statement of financial position? When the firm has finished transacting their transactions for a full year, it's statutory that they would normally file reports. Based on these reports, that is where their tax liabilities have been evaluated and measured by the tax authorities. Now, statement, we have different ones. We have the statement of financial position, which is the position at the end of the year. So if your firm's statement of financial position year ending is 31st December, which is the case for most companies here in Nigeria. So it's going to be something like IBRA's statement of financial position as at 31st December, and they have a format for it. We are going to look at all that, and they also have the statement of profit and loss and other comprehensive income, which we'll look at. Now, in doing this, if you have a group, then they have what they do, group accounting also. But we'll go that straight into that. For now, we are going to look at the consolidated statement of financial position. While I'm explaining this, you will understand, you have to understand the spirit of what it is. No cramming here in this. Understand how it's all linked up. So, we'll go on the consolidated statement of financial position. If you open up your, now if you have that opened up somewhere to aid us in terms of the questions, we are going to solve example 3 and example 4 today. But let's go straight into this. Okay. Now, who is a parent? What's a parent? For you to understand, parent subsidiary, control, key things. Now note, for you to say you have a subsidiary, it clearly means that you have 50% of the voting rights. 50% of the voting rights. So, I will draw something like this. I will say, here is 20, 0, 50. What is 50 and above? You have a subsidiary. $20 to $50 is an associate. we're not going to be dealing with this. This is generally like a financial instrument or so. An investment or so. Now, you have to be able to identify this. As a parent, if you say you have a subsidiary, the key thing is this: you have control. Once you have control, then you have a subsidiary. Control, which is 50% of the voting rights. But if you have between 20 to 50 is an associate. Now it's good for you to know, have these figures in your head, because in consolidation, we normally, there are rules that we apply. Associate. Which we are going to see in here. Okay. Now, and there are steps in which we go about consolidation of accounts. F7, you follow the steps, I tell you, you don't have a problem. Because what they will give to you is, they will give to you the parents' statement of financial position. They will give you the subsidiary and they will say consolidate them. It is easy, lemon squeezy. There's no problem. Don't get scared about it. Because once you're done with it and we solve these questions, there's no other. I think you have to tap okay if you understand what I said. I love some form of activity. So I know I'm not just talking to myself. It's quite strange. Having to do this, I'm the only one in the classroom. I wish I could see your faces. And I'm sure you have this all sorted out. Now, if you go into your book, you will see the first steps in terms of consolidation. Okay. I will slow down a bit so you can hear me very well. Okay, but before I do this again, let me recap. Ijoma said I was a bit too fast. Well, that I was a bit too fast. Now, let me recap. One of the things in your syllabus is called consolidation of financial positions. Now, it is part of the syllabus. That should be IAS 27. Now, in breaking down financial reporting in ACCA, so what you are going to be doing is basically knowing how to recognize transactions and events according to this IAS. There are some of them, you are going to do more of the basic things here in F7, which is financial reporting. Then you see more of them in strategic business reporting, which is in a professional stage. So here, if you go through your syllabus, you will be seeing things like leasing, which is IFRS 16. You will see things like contingent liabilities and assets. You will see things like PPE, property, plant and equipment, which is IAS 16. You will see things. Now let me explain something. Now for a financial, so you have a pictorial view of it. Let me say this is Ijoma CSFP. CSFP is Consolidated Statement of Financial Position. As at 31st December 2018. Now, you will see things like this. Let's say this. Then you will see things like PPE, property, plant and equipment. X, it comes under here, it's a debit, it's a credit. Note, somebody's off. PPE, then you see things like goodwill, which comes under here. Then you further see things, these are current, non-current assets. Then you see things like current assets. Inventory. You see things like bank. You see things like cash. Then you see things like equity, which is the shares. Here you see things like share premium. Here. Okay, I think it's just people that here. Now, the essence of this is recognition of these figures here. You can't just put any figure there, because in your day-to-day transactions which you record as an accountant in your books, those figures are being transferred to the trial balance. From the trial balance, which have all been aggregated, it is now being transferred down to your statement of financial position or your statement of profit and loss. But they are IAS's International Accounting Standards, and they have recognition criteria, measurement criteria that you use in order to recognize them. An example we have is IAS 16. IAS 16 will tell you this is valued, whether it's going to be valued at cost, whether it's going to be valued at current value, whether it's going to be valued at invalid value. It will tell you that. Then we have inventory, which should be IAS 2, you can correct, which will tell you that it is measured at net realizable value, at the lower of net realizable value, or the cost itself. I just have Ibra, so we'll still continue. The others should join me. Net realizable value or the cost itself. Now, what financial reporting does for you here in ACCA financial reporting is that we are looking at these standards. All these have their own standards. We are looking at these standards and knowing how to recognize them, knowing how to measure them. Are these liabilities? Are these assets? How do we recognize them? Do we put them in the notes in the account? Or do we recognize them at their cost? Because sometimes you have things which you bought 5 years ago, and over the years they must have depreciated in value. Over the years they must have appreciated in value. A good example is land. Land is recognized at the cost. So you get, after doing this part, now if this guy who is here is a parent, let's say this financial report belongs to the parent, he now invests in a subsidiary, in another company, and has a controlling vote of more than 50%. He has the shares, he bought into the company, and he has 50% interest in it, meaning that the other shareholders might have like 20, 10, 20 and split into 1 or 2. That means the parent has the right to put in who's going to be the director. They will have more people on the board. And if you have more people on the board, that means you control not just operationally, you also control on a strategic level. That is where the control comes in. When they say parent and subsidiary, control is synonymous. When you hear subsidiary, control is synonymous. Does he have control? Does the parent have control? If the parent has control, then that company is a subsidiary to the parent. Company A buys 65% of the shares of company B. Now, do they have control? Yes or no? Yes, they have control. Because if I buy 65% of the shares of your company, I will tell you what to do. You can't tell me what to do. I will put in a director that has a listening ear to what I'm saying. I will have more people on the board. that would foster my agenda. That is control. Now, this is a clear case of, we're still going to talk about substance over form. So in that case, if the parent has control, it is typical and logical that in group accounts, when we are grouping the accounts, there are things I will show you on how we will do that. The accounts are merged into one. Then there are steps that we take into it. Now, that will lead me now to an associate. Okay. Now, that will lead me now to an associate. For an associate, if you bought, let's say, 20% of the shares of your company A, and you bought 20% of the shares of company C, you do not have control. You have an influence. So between the parent company and parent company A and company C, which they have 20% interest in, they have an influence in it. Influence is different from control, because we might not be able to put in a director, but we have a seat on the board. So even if the guy who has 50% is able to put in the director and everything, at least we have a voice. We can influence one or two things. So note, between an associate and a parent, it is influence. Note, it is influence. Between a parent and a subsidiary, it is control. Ijoma just joined us, so I will just try to fast track on what I said earlier so she knows. This is a case of an example of, it's not that complete, of a consolidated statement of financial position of, let's say, of Ijoma. Now, what we do in financial reporting is, this is like a format. Each of these things, they have international accounting standards, for IAS 1, IAS 2, IAS 16 and others. Now, we have to, you record things daily. When you buy, let's say, you buy a pencil in the office, it's being recorded. If you sell something, it's being recorded in the sales day book. If you buy, as you're buying those things at the end of the day are being transferred to the trial balance, which is being transferred to this for you to print this. So enough of that. Let's go to how we would do the consolidated statement of financial position, because I want us to solve 2 questions at least before the end of this session, so your mind will start asking questions. Okay. First step in the consolidated, first step, so first step is that you open up the CSFP. What do I mean by you open up a CSFP? You go to a blank page and you write, like we did before, Ijoma, if the company is A, company A, consolidated statement of financial position as at 31st of December, or as at when it was listed, when it was, what was put in the question. Open up a blank page, leave it. Welcome, Ufoma. You open up a blank page first of all. Second step, is the group structure. I know you have a lot of questions, but just relax. We'll get to a question now which will explain most of these things. Group structure is, in the question they will tell you company A had 80% of the shares in company B. In solving that, this is an example of a group structure. Parent, subsidiary, let's say 75%, then 25%, NCI. CI. 75% CI is controlling interest, which is what the parent has. Remember we said the parent has, for this to be a subsidiary of the parent, it has to have 50% or above 50%. So 75% controlling interest and 25% non-controlling interest. These are steps in solving the questions. Then the third one, then we have consolidation adjustments. Now, for consolidation adjustments, in the questions you see things like a plant was bought for like £10,000 and the current value as at when it was bought was £15,000. You have to make adjustments for that. That's why I told you that we work according to the international accounting standards. These are, I wouldn't say they are rules, it's in America they use rules, but in terms of it, these are principles which you recognize transactions. Now when you see something like that, you have to do consolidation adjustments on it by saying, okay, you adjust the net assets list. We'll see the net assets list. The net asset is simply your total asset less liabilities. In actual sense, your total assets less liabilities in accounting is what? Total assets less liability. Remember, I will still clean this up. Assets plus equity. Assets is equals to equity plus liabilities. Now, when we have assets, net assets is net assets is equals to assets is net plus liability. So your net asset is actually when you do assets less liability. So if you say assets minus liability, according to this first equation, what does it say? This is equity. Am I too fast? Are we good to go? Okay. I cannot see anybody saying no. So, note, this like this is called net assets. And why that is quite important, thank you very much. Why that is quite important, the net asset is quite important is this. If you buy, normally when you buy a company, you find out that if you itemize everything like the computers, the fan, everything right down there, you cost everything all up. Everything might be 80 naira. Let me use the naira. But you now find out that the company will be paying like 100 naira. Why is the company paying 100 naira? Let me use something that you are all familiar with. You want to buy something. You want to buy a house. The first thing you do is you want to buy it with everything inside of it. If I were the one that was selling the house to you, before selling the house to you, I would find out the current cost, of the computer, the chairs, the television, the bed, every single thing in it. And at the end of the day, it hits up to 80 naira. Now, if it hits up to 80 naira, you now decide to pay me 100 naira. What's the difference of the 20 naira? The difference is called goodwill. Goodwill can be linked to, generally seen like things that are being linked to the people in the organization, the reputation of the organization, things like that. Now, net asset list and goodwill, they go together in a way. You will see them very soon, because in calculating it, we list out the net assets. Because of we don't want to go and start calculating inventory, cash, this, that. We wouldn't want to do that. So we are using reverse in calculating the net assets, which is here. Because of the net assets, it equals to the equity. What we do is, for the net asset list, you have things like everything that is in under the non-current, like you have things like the shares, you have things like the premium. These are constant. I will show you right now. Be patient with me while I continue this. I'm just showing you the steps on solving consolidation for this. Then we have this, which is a goodwill calculation, non-controlling interest calculation, consolidated reserves. These are called the big three. Now you have to be systematic in how you go about this in your mind. You have to put these steps in your head when it comes to consolidation of the financial position. You have to put it in your head. When the question comes up, you open up the account. IBRA consolidation of financial position as at the 1st of December. I seem to love the 1st of December. NTI stands for non-controlling interest. Non-controlling interest. I'll come to this. Let me just do this like this. When you open up the account on a blank page, first you skip it. Don't write. The only thing you write there is like company A, consolidated statement of financial position as at 1st of December 2018. You write it, turn over to the other page. Then you now do the group structure. In the question, thank you. You're welcome, Iba. In the question, they will give you. Sometimes they might tell you the outright is 80%. Sometimes they might tell you that the company has 4,000 shares in company A has 4,000 shares in company B's account, which is 6,000 shares. What you have to do then is 4,000 divided by 6,000 times 100. 4,000 divided by 6,000 times 100. I was too fast here. To know the percentage. If the percentage is above 50, you have a subsidiary over there. That done, which is this. And you now list out 25% NCI. You have to be clear, because you have to let the examiner know that you know what you're doing. This will come into play when we are calculating NCI, which is non-controlling interest. Because the non-controlling interest is a liability. Now that will come in the consolidated statement of financial position. Then we now go to the consolidated reserves, which all this will come in the consolidated statement of financial position. I'm sure you have all this listed out. Now I want to do a small question. I want to do a small question why I'm talking about these things. Before I talk about that, I would list out, before I talk about it, I'll list out the net assets for you, so you have an idea. Then, for the consolidation of financial position, how it's normally been done, let me clean this up. And we have 1. Now, let's say we have non-current assets PPE, current assets, we have inventory, equity, we have shares, we have retained earnings, and we have current liabilities. And just current liabilities. And let's say we have this Paul and we have Saul. We have here 300, 100, 200, 180, 80. All this comes to 480, 180, 80, we have 200, and these we have 280, 300, 100, 200. And let's say this is 80 and 100. 180, 40. Okay. This is total assets. Total equity, liabilities. Okay, I'll use this to explain. Now this is Paul and this is Saul. Paul is the parent and Saul is the subsidiary and has 80% of the voting shares of Saul. This is statement of Paul's consolidated statement of Paul's statement of financial position. This is Paul's statement of financial position for the year, an individual account. This is Saul's statement of financial position for the year, an individual account. Now, let's say they have the same account year end, 31st December, 31st December. Now, your job as a group accountant is you take the statement of financial position of the parent and the subsidiary and you group them all together. It's easy. For things like PPE, what you do for most of these things, they add up together. And you get easy marks for them. But there are some things which you cannot add up. Things which you cannot add up are these. When you are putting in the shares, only the shares of the parents. You don't put this. Liabilities, you add them together. Inventory, you add them together. But note, intra-trading from parent to subsidiary is not allowed. So if the parents buys the goods, let's do this. If Paul buys a good for 100 and marks it up by 120, and sells it to Saul for 120. Okay, Joma, what do you want me to explain? You have to type what I have to explain. I've said a lot of things. While we're waiting for her, let's continue. So if Paul buys a good for £100 and he puts a markup of 20% on it, okay, you cannot add up. Okay, I get the question now. You cannot add up shares. You only use the shares of the parents. So at the end of the day, your consolidated statement of financial position is going to be 200, not 80. And I will tell you why. When we get to the net assets, I will tell you why. Now, but for most of the lines, like inventory, they all add up. But the other thing I want to tell you now is intra-trading is not allowed. So whatever markup, intra-trading is not allowed. It's almost like you're married now, and you have a joint account. Husband and wife, they have a joint account. And then the husband gives the wife a check to go and cash it. It makes no sense. Now, if company A, who that's the parents, okay, let me use Paul. If Paul decides to trade with Saul, thank you, IG, and Paul buys something for 100 and sells to Saul for 120, at the end of the day, inventory is overbloated. You will be showing now, let's say this is 80. I don't want to change it. Let's say here now it's 120. Do you agree with me that you are showing because these financial statements are being presented to the shareholders? You have to know the end game. The end game is that you do statement of financial positions, you do statement of profit and loss. These financials that you create are being presented to shareholders who put in their money in the company. The director runs the company. The shareholders are not aware of the operational activities that happen in the company. So they depend solely on these financials. So the essence of financial reporting is so that you would actually give a fair representation of the activities in the organization. So if intra-trading is allowed, you are giving an overbloated asset. You are selling to yourself. A company can decide to sell to itself at 120 and the account is bloated. Now, instead of the shareholders to see 100, which the guy sold, they'll be seeing 120. It does not give a fair representation of the financial statements. And these financial statements are what are being depended on, not just by the shareholders. They have different stakeholders. People that lend you money and other things. Thank you. You get me now, so I can continue. Now, the aim is, when you see intra-trading, you take it out. What do you take out? You strip this 120 off the 20. And make sure it represents only 100. The ideology I just gave you is called POP. What is POP? Provision for unrealized profit. Provision for unrealized profit. Ijoma, did you get the idea of this poem, or do I have to repeat myself again? If you got the idea of the poem, please say okay, because this is very important. It comes out in every question, because the examiner wants to know whether you understand what we're saying. Assume you actually got it. So if we have something like this, and they say that they have this markup of 20%, they have the markup of 20%, you have to take it out. So let's continue. The next thing I'm going to go on, yes, provision for unrealized profit. Okay, let me clean this and I'll explain the POP. Very good. We are close to solving the question. Let me talk about POP. Provision for unrealized profits. Now, one company A, I'll give you a real life example. Let's say company A sells to company B. The cost of what they bought is 100. But the guy now decides to put a markup. Remember, company B is a subsidiary of company A because company A has 75% of the shares in company B. So he puts a markup of 20%. Now when they say somebody puts a markup of 20%, it simply means you did 100 times 1.2. 1.2 is simply 120%, which is 120. Are you okay with this? Please tell me you're okay with this. I guess you're okay with it. Now, in doing consolidation of financial position, you will see that in company B's books, company B bought it for 120. So of course it will be in 120. It will be 120, let's call this inventory cost. Of course, in company B's inventory cost, this will show 120 pounds. In their individual account, no wahala, it's okay. But in doing group accounts, because you have to see yourself as a group accountant now, in doing group accounts, and we want to group these accounts like this, we only have, now, if company B has not sold the full goods and everything is still in the inventory, what we do, note this, Ibra, Ijoma, Napoleon, note, if they have the full 120 in there, what do? We say, one minute. If they have the full 120, I would say full. Full, okay, I would say, no, no sale yet. They haven't sold this yet at the end of the financial period. What do? You do 20 over 120. Note, times 120. This will give us 20. This is the POP. Why is this needed? Because when we are doing our consolidation, remember we talked about the net assets earlier on. We are going to deduct this. We will deduct it. Now, if he has sold half, if he has sold half of it, what do? Half of 120 is 60. So he still has half of it in his account, in his store, half of the inventory in the store, in order to get the POP. Because note, if he has sold half of it, whatever is sold is gone. It's out of the company. If it is still within the company, you cannot account for it. If it is out of the company, there's no wahala. You and your husband, you both have a group account. If you get extra money from outside, or okay, let's say you are selling something, if your husband sells to you at a markup, we have to remove the apoko which you put, or let me use the other way around. If you sell to your husband, you bought a school bag for your children and you bought it for 100 and you are collecting, you now tell your husband, I bought it for 150. 50 is the POP inside. That is what we call the apoko. We have to remove it from it. But let's say you sell to your husband a wristwatch, 3 wristwatches. It's supposed to be 100 naira, and you sold it to your husband for 500 naira each. That means your cost price is 300 naira. Your husband bought it for 1,500 naira. Now, if your husband sells 2 out of that watch outside of the family, you don't account for those 2. You don't account for it in terms of the POP. What you account for is the POP on the last remaining inventory at the end of the year, which in case of this one is going to be 400, because you bought watch for 100 naira, you sold to your husband for 500. I'm sure none of you actually do that. So for this, it's going to be 20 over 120 times 60. And that's the POP is going to be 10. Please, you have to confirm that you understand this, because we are close to a question that we are supposed to solve. I need confirmation. This is key to the next step. Okay, no response. Clean it up. Wow. Okay, now I go to the net assets. Remember while talking, we talked about opening up. Okay, it's okay. Thank you very much. We talked about first step, opening up consolidated statement of financial position. That's taken care of. That's the explanation I'm giving. Second step, we talked about group structure, which is okay. Now, the one we are going now next to is consolidation adjustments and net assets list. So we'll talk about the net assets list. These are things that we use in achieving consolidation, group account consolidation. Okay, net asset list. You will see we normally say net asset list as at. Most of these things, they are all in your notes. So asset acquisition, and consolidation. I'll write them out and I'll let you know. OSC, share premium, retained earnings, fair value adjustment, up, acquisition, depreciation. Okay, I told you about the net asset list. The essence of the net asset list is at acquisition. Net asset list is, like I said earlier, you're trying to buy a house. Let's say you're trying to sell a house, not buy, sell a house. You would want to cost the wardrobe, the chairs, the TV, everything, to know the actual cost that goes in there, so you know how much it is valued at. Now, our approach is asset is equals to equity plus liability, but we don't want to use that, so we are using asset minus liability is equals to what? Equity also. Asset minus liability is equals to equity. So we are using equity here. This is the net asset list. I'm just telling you how we got about it. Once this is ordinary share capital, blah 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 blah. All this, like I said earlier, is you want to sell your house and your house is costing, after calculating everything inside, it's 80 naira, and somebody now gives you 100 naira. 20 naira on top of it is called goodwill. Now, this A, which is the 80 naira, is very key, because you have to know your net asset cost at acquisition, so that you can be able to know what the goodwill is. If you don't know how to arrive at that 80 naira, then how would you know the amount of goodwill? Somebody pays you 100 naira for your full business, and you know everything, and you don't know the cost of everything which is there. You can't calculate the goodwill. So this is key to help you calculate goodwill, because goodwill is one of the things which will be featured on the consolidated statement of financial position. And another thing which you will note if you check through this is also, why we do this also is that we also calculate at consolidation date. All of this. The difference between this, B minus A, the difference between this would help us to calculate the NCI and also calculate the consolidated reserves. Why do I say so? Yes, you have control. Now the NCI, the non-controlling interest, has 25%, and you that have control have some 5%. What do you do? I wish German would not go off now. Seems to be having an issue. Give me. Let's take a break for now. We will continue in 5 minutes time. Pause. We'll continue in 5 minutes time. So just pause it. It's the same link that we'll use. I will be back in 5 minutes so you can process everything we've said, because the next time would head straight to a question. Let's not do it. 5 minutes. I will be back. Okay, somebody's back. Okay, let me just write this thing all out so the explanation will be very, very quick. NCI. Aha! We are here. Okay, let me write this thing out so it will be quick to explain. See that fair value as acquisition. Okay, I just have your idea, so we'll continue. Now, we'll go to the goodwill and NCI, and after that, the consolidated results, and we'll do a question. Calculation of the goodwill. Now, I will still use my illustration of 80 naira. The total assets in the house is at 80 naira at acquisition. That is, now, okay, let's start from here. You want to calculate the goodwill that is achieved that somebody gave you 100 naira for all the things in your house, less 80 naira, which is the worth of everything. Now, that 80 naira is being shared into all the things that is in your house. The percentage is between you and your husband. Let's say your husband is the CI, which is the controlling interest, and you are the NCI, non-controlling interest. If you add up, if your husband has 75% interest and you have 25% interest, that's all 100% interest. So that is equal to the 80. In terms of our illustration, this is the 80 naira. CI and NCI at fair value. And this is the 100 naira which was being paid to you. This is how to calculate goodwill. Now, when you have investment at cost, which is what is you paid for, whoever paid for your house, which is 100 naira. CI, NCI, your husband is the CI, you are the NCI, 80 naira. This gives you, then, this figure here, X. Then, net, less the net assets at fair value. Less the, what did I say? Wait. Investment at cost. Investment, leave this. Let me come again. This is the 80 naira. This is the 100 naira. Investment at cost. Now, CI and CI, this is what the person paid. Welcome, Ibra. We are the goodwill part. Now, for this is what the person paid for your house, which is 100 naira. Let's say the person came with has 75%. Another person bought 25%. This is the total, 100 naira. Remember the illustration that we used, that you want to sell your house, somebody paid 100 naira for it, while the total assets in your house is 80 naira. So CI, NCI, 100 naira, less net assets at fair value, which is the 80 naira. Now, if you do that, that's the goodwill at acquisition, which is the 20 naira. I'm sure you understand what we're talking about. Now, less impairment, it's, let's say you have a freezer that the cost of the freezer in the net assets, you put it at 20 naira, but something is spoiled, let's say the compressor, and the value of that freezer is depleted by 10 naira. Now you will come to less impairment and put it less 10 naira, and that will be goodwill at net book value. This is goodwill at acquisition, note, then net book value. The difference between goodwill at acquisition and goodwill at net book value is the impairment. Capiche? Now we move to NCI. You will understand this more better when we get to a question. NCI. Let's not forget, I hope you have your LSBF material in front of you, because that is what will make this make sense. Because in solving the question, I'm not going to write down the question here, I'm just going to read it out. NCI. The NCI is the guy in the business who has 25%. And we have to recognize them in the consolidated statement of financial position. That's the guy we have more than 50% interest in their shares. NCI at fair value at acquisition That's the cost. Something like they say, at the time when we bought the shares was worth $2 and the NCI had 1,000 shares in it. You do $2 times 1,000 shares, and that will be here. Now, between the period of acquisition and consolidation, there is a space. You acquired something 5 years ago. Okay, let's say you acquired something on 1st of January 2018, and you are doing consolidated statement of financial position at 31st December. Between that time, 1st of January and December, you must have made some profit. Down here is NCI percentage of post-acquisition profit, meaning that if you acquired it at 1st of January and you are doing consolidated statement of financial position, okay, and we are doing consolidated statement of financial position. If you don't understand, let me know. Now, what will happen here is 25% times whatever you made. If between 1st of January to 31st of December, the company, the subsidiary as a whole, has made 1,000 naira. Now, you will come down here and put 25% of 1,000 naira is down here, you put 250. But note, if you acquired the subsidiary on 1st of July and you made a profit between 1st of January and 31st of December of 1,000, you cannot put 250. You are going to do 25,000 times 1,000 times 6/12. 25% times 1,000 times 6/12. Why 6/12? Because you acquired the subsidiary on the 1st of July, which is 6 months to consolidation period. Because here is NCI percentage of post-acquisition from the time when you acquired it till when you do the consolidation. And this is going to be 125 as against the 250. Note this, because these are skills that we are going to use in the question. Then that will be NCI in the CSFP. Now let's move forward. The last part we have to do is the consolidated reserve, and we will do a question. For consolidated reserve, it is the reserve of the parent. Note, parent. We are not doing the reserve of the NCI. No, we have done that. We are not doing that. So it's the reserve of the parent. So the idea is still the same principle. You will take the reserves, things like retained earnings, you take the reserves of what is listed in the statement of financial position of the parent plus post-acquisition of the profit. So if the parent has 75% of 1,000 from January to December, you do 75% times 1,000. You get. Now, with other things that comes in, if they are associates, you put it there, but we'll treat associate next class. So this is parents' reserve, parents' own reserves, X Okay, I forgot something in that NCI. For the NCI, you also do less of impairment. They have their share of the impairment. So if the impairment is, we talked about the fridge, that the compressor was bad, and let's say it loses a value of 10 naira, the NCI will have less impairment of 25% times 10 naira. For here, parents' own reserve, this you plug from the question, you always see from the question. And you get sweet marks for it. Then adjustment, evaluation of all. For evaluation, we said, if let's say you bought something at the parent has something which is on the book is 1,000, but it's at fair value it's supposed to be 2,000. It's been adjusted here. You add the 1,000 here, and this is for poor. If the parent sold to the subsidiary, at the end of the day, down here, you have to remove it. Then, plus group share of post-acquisition reserve, if it was acquired at 1st of July, you know you have to take half of the year. Then less impairment. Do you understand? Because we are about to do a question and we'll use these skills for. Please tell me you understand, because I'm going into example 3. I need to hear you. I understand. Hello? Somebody say you understand, because we are going into the last phase. Just tell me. Type. Say something. Tell me you understand. Please. I want to know you understand. Welcome, Uforma. You have been joining us off and on. That's what I want to hear. Go ahead. Now we go to example 3. Thank you. Now, example 3, normally when you get a question, first thing you do is you read the requirements. Leave all the plenty drama they put in there. Look at the requirements. Example 3, it says requirements, prepare the consolidated statement of financial position for the POL group as at 31st December 2014, assuming the payment of goodwill to that date is $60,000 and that no shares were issued by store since acquisition. So what do we do? I will share this into 2. What was our first step? Open up a blank page of statement of financial position. So we come here and we say whole group of consolidated statement of financial position. In the question it says as at 31st December 2014. As at 31st December 2014. You get a mark for that. What's the second one? This is the first one. Open up. The second one is what? Group structure. Now we'll go to the question. It says, Paul paid $700,000 for a 75% interest in store. You have to underline these things. On 30th of June 2012. Now what do we do? This is Paul. And this is store. 75% CI. 25% NCI. It's coming into shape now, right? And what is the duration? 30th of June 2012 to 31st December 2014. So, this is 2.5 years. Acquisition to consolidation. Done. We have done the second one. I'm going to clean this off so I can have more space. Note, 2.5 years. What's the third step? Adjustments. Consolidation, adjustments. Now let's look at the statement of financial position. Property, plant and equipment, investment, shares in stores, 700. Now let us see. Under current assets, you will see they said subsidiary company current account 200. Then go to current liabilities, you will see parent company current account 200. That's intercompany. Note, intercompany trading, which has been put there. Intercompany trading normally contracts out. But you have to speak the language of accountants. So for the adjustment, we say, okay. Let me tell you something first. Assets, expenses, and losses. If you want to increase these items, what do? You debit it. If you want to decrease it, what do? You credit it. Same thing we have for liabilities. Let's say gains, assets, liabilities, gains, expenses, revenue. We are on page 35. Page 35, that's where we are. Now, if you want to increase this, you credit it. If you want to reduce it, you debit it. To compare, so this taken care of, we now go down to solving these questions. Now we said we had intracompany trading. In the parent account, we saw under current assets, subsidiary company current account 200. That means the parent is expecting some inflow. So what do? In contraring that out, we debit the parent's book by $200. Remember I said the parent is expecting an inflow. So we debit and for you to reduce revenue, you have to debit. Revenue, for revenue, if you want to increase it, you credit it. If you want to reduce it, you debit it. So for the parents' books, they are expecting money. It's more like, so we debit it. And in subs book, we credit the 200. Subs book, we credit the 200. So it's a contract. This is called a contract. We contract it out. They can't be one. We just contract them out. So that's under the consolidation adjustments. Then we move to the net assets. So I will say net assets. Net assets of subsidiary. Remember, net asset is for subsidiary. Net asset is never for the parents. Why is net asset only for subsidiary? It's for subsidiary because you are buying. Since you are buying from them, you want to know you are paying for that 100 naira I talked about. So you want to, the essence of net asset, it helps you to know how you will calculate your goodwill, because the net asset at acquisition gives you a figure which is equal to that 80 naira I told you if you quantify everything in your house. So what you are paying for 100 naira less that at acquisition, net asset, which is net asset of subsidiary as acquisition. This is acquisition and consolidation date. So the figure I get here, the figure I get at acquisition, which is 80 naira, I now do that 100 naira minus 80 naira and I get my goodwill. It helps me. Now at consolidation, which is for this, if I do this value less this, it helps me to be able to calculate the percentage of NCI post-acquisition reserve, which is needed in the NCI calculation and also the consolidated reserve calculation. We are there. Okay. So looking at the question, we say for subsidiary equity shares of $1 each. Look at it, it's 300. So we'll go here, ordinary share capital, 300 here, 300 here. Never changes. Always constant. Then share premium. Share premium. $100. 100 here, 100. Retained earnings. I'm going to enjoy this. For retained earnings, let's look at the question. The subsidiary shows 200. That 200 will go here. Look at it. They say this financial statement you are seeing here is at 31st of December 2014. So the retained earnings is, these guys have been trading since store here was bought 2.5 years ago. So since store has been trading since 2.5 years ago after acquisition up till now, store has in their retained earnings. Retained earnings is that like the money you have saved in the bank. Store has up to 200 naira as at 31st December 2014. Now, what did store have at acquisition? It can't be, you can't tell me that store had 200 at acquisition and today they now have 200. Is it that there's no activity? So we'll have to find out what it is. And from here, this question, it says, Less one. He says, read the question again. He says, Paul paid $700,000 for 75% interest in store on 30th June 2012 when the fair value of store shares were $2.4 each. Now, listen, since the date of acquisition, store has made accumulated profit of 120. Since acquisition, store has made 120, meaning that from 30th June 2012 to 31st December 2014, store has made 120. $120,000. That means at acquisition, store had 200 minus 120. Just tell me you understand and I'll be excited. Store actually had 200. Look at it. This statement of financial position is at 31st of December 2014. This one. So consolidation 200. Capiche. Good. We are good to go. But what did store have at the time we bought into them? What did they have at the time we bought 75% of their shares? The question says that they had from that time till now they had 120,000 accumulated profit, meaning 200 minus 120, 80,000. So here is 80. This is 1,000. Sorry. Quickly, we are almost there. So, based on that, we do not have any pop in the question. We do not have any accumulated depreciation. Yes, I did not tell you about accumulated depreciation. Now, I told you if you have like a non-current assets, plant, equipment, which was worth $1,000. Let's use example as at 30th June 2012. Let's say this is not related to this question. Then the fair value as at then is let's say the fair value is now 5,000. Meaning that what we have in our books is wrong. What do we do? And they say the plant has 4 years left in its lifetime. You now have to do, apart from recognizing in here, we don't have any fair value adjustments to put here. If not, we'll put here and here. Apart from recognizing 4,000 here and here, we'll also recognize the accumulated depreciation, which is, if it's a straight line on 5,000 less this is 4,000. And if they say the plant had 5 years left, let's say from this to 13, 14, 15. Let's say this is 5 years. Acquisition, consolidation. I hope you can see. It was bought this was in the books for 1,000. And now at consolidation we found out that the fair value at that time was 5,000. So the fair value adjustment we'll put down here will be 4,000, 4,000, but that's not finished. We'll also take 4,000 from here to here is 5 years, and let's say we'll do 5 divided by 5, and that value multiplied by the time we'll put it here in consolidation. We'll still come to that question, but I just wanted you to know about accumulated depreciation. Okay, let's continue with this. From this, I see there's no pop in this question. There's no fair value adjustment in this question. So we are good. If you add all this up, this is 480 and this is 600. So that's good. Now, okay. Quickly, let's go to goodwill. Please take note of these numbers. Take note of these numbers because we are going to use them. This is our blank page. Sorry for writing down here. Then let's just do goodwill here. I'll still take it off. Goodwill. I'm not doing that. And not mess up the blank page. 480, 600. I have it here now. Please, you guys stop going off. I'm almost done with this question. After this question, I think we can close for today. Now, goodwill, if you look at the question, they say, Paul paid $700,000. That is the investment that Paul paid in stock. Look at our pro forma that we have down there on goodwill. So this is investment. Investment at cost. CI, control interest, paid 700,000. 700. NCI. NCI is what? Now we look at the question and it said Paul paid $700,000 for a 75% interest in stores 30th June 2012 when the fair value of store shares were $2.4. Good. Now the shares that store has is 300. NCI is 25% because if Paul has some 5%, 25% is controlling interest. 25% of 300 is what? Your calculators. 25% times 200, this will be 25% times 300. This will be 75 multiplied by this, and we have 180. Please check the calculation that they are okay. Then we have less the part for net assets. Less subs net assets. You remember earlier we had net assets at acquisition for 480. This is 880, 480. Now this is goodwill at acquisition. If we do this, what do we have? We have 400. What do we go to next? Impairment. Less impairment. Note, for the goodwill, you take the full impairment. Remember, CI and CI, it is when you get to this consolidated reserve, you start doing some the parent share of impairment and NCI share of impairment. So in the question, it says, at the requirement, it says, impairment goodwill to that date is $60,000. So this is going to be 60. At the end of the day, we have 340. That is goodwill at net book value. Take note of these figures because all these figures are going to go into the statement, the consolidated statement of financial position. It's just going to, when we get here, it's just be plug and play. Pap, 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 pap. This is where the hard work is. This is where you do your workings. But if you do your workings and you don't plug them in, you won't get that mark because the requirement says prepare the consolidated statement of financial position. It did not say prepare workings. So let's quickly go to NCI. We are almost there. I'm surprised I timed this thing almost there. I know, sorry I'm taking a bit of the time. Success. So we have NCI at fair value at acquisition. What's the NCI? Remember we calculated NCI doing goodwill. We said $2.40 times 25% times 300, and that gave us 180. That said, figure goes in here. It's the valuation. We are valuing what's the. So now the next one is NCI percentage of post acquisition. Of post acquisition retained earnings. Now, what would we do? We did in net assets, at acquisition we had 480. At consolidated we had reserve, we had 600. So what the company has made between, the net asset is key. What the company has made between consolidation, which is 600 minus 480, is 120. Check your net assets total. At acquisition it was 480, at consolidation 600. The difference is 120. That is what they have made between 2.5 years ago that they bought that up till now. So now this is going to be 25% of 120. And that will give us 30. Then less NCI percentage of impairment. Impairment is what? 60,000. NCI is what? 25%. 25% and 60,000. Let's say 60 because we have this over here. 25% of 60 is going to be 15. When we add them up, this is 195. And that is NCI in. One last thing to do will be the consolidated. Take note of these figures, they are all going to be plugged in. Consolidated reserves. That is the parent's own. So, consolidated reserves. So we have parents own, which is the CI. Look at the consolidated, look at the retained earnings for parents. That is 1,000 in the question. Oh, that's 1,100. Now percentage, now it will now be percentage of the profits that have been made between 2.5 years till today. The percentage is that net assets consolidated statement, that is the 600 less the 480, which is 120. So that will be parents percentage of post acquisition reserves, which will be 75% of 120. This will be 90. Then less impairments. Parents percentage of impairment, which will be 75% of 60. Remember the 60,000 for impairment. Of impairment, 45. And that will give us 1145. This is the consolidated reserves. Reserves in CSFP. I'm glad to announce to you that we have finished working, so let's do the plug and play. And doing the plug and play in here, four group of consolidated financial position are this. We have PPP, PPE, property, plant and equipment. What do? We add across. We have 900, look at the question, example 3. 900 plus 500, that will give us 1.4. Easy. 900 plus 500 1,400. Then we have current assets. Current assets. Current assets, inventory and trade receivables. We have 350 and 400. Easy. 350 plus 400. Easy. That is 750. That should give us everything 2,490. This is total assets. Total assets. We just have one left, equity and liabilities. Equity and liabilities. For equity, like I said we only take the parent's own. So under co-equity, we have ordinary share capital 600. Remember, for the current asset, we contract out the 200, so it's contract out. You don't put that in. Then share premium, only the parents. Like I said, 200. Now plug and play. I forgot to put something here. Wait. Let me use my space pen. I forgot to put something here. We did not put the goodwill. Property, plant and equipment, we got this one. Then goodwill. Because goodwill comes under non-current assets. What was the amount we had for goodwill? Check your calculation, the one we did earlier. Goodwill from working that we worked, we had 340. Should have brought that in. 340. Then all this is 1,740. Then current assets. What did we do before? We have done goodwill. No, we did open up accounts. We did group structure. We did consolidated adjustments. Then we did goodwill. Goodwill has entered in now. We have plugged it in. Then after goodwill, we should have NCI, which we're expecting to put in here, and consolidated reserve, expecting to put in here. So current assets, we have inventory, which is 350 plus 400, 750. Then remember I told you about P's, books, and so contract. That is 200 minus 200, the one we talked about, name. And this goes to 750. Everything gives us 2,490. Equity and liabilities. Almost done with the question we are plugging. Sorry, IJ. Okay. For the impairment, before I go ahead with the plug with everything, impairment is like this. I told you I'll still use the 80. You have things in your house which you want to sell. Okay, let's say which you want to buy something from somebody, and the person now prices everything in the house, checks everything in the house, everything is up to about 80 naira. You give the person 100 naira. 100 naira minus 80 naira is 20 naira. That is the goodwill. Now, in the person in the person building up that cost of the 80 naira, a fridge was included in that 80 naira for 20 naira. You now find out that the compressor of the fridge is bad, meaning that the fridge is impaired. Impairment means that it has lost its value. If a thing loses its value, it gets impaired. That's the simple explanation. So that fridge, if the compressor is 10 naira and the fridge was initially valued for 20 naira, it has been impaired by 10 naira. So you have to put in that 10 naira for impairment. So when you are doing it, your goodwill can be impaired, will be impaired by 10 naira. So instead of having goodwill now, you paid 100 naira and the cost of everything was 80 naira. Now, goodwill at acquisition. Look at what we did for goodwill. Goodwill at acquisition is 20 naira. Less the 10 naira of the impairment that affected the fridge compressor. That will now be goodwill at net book value. Now, in valuing the non-controlling interest, that's the person that has 25% interest, in valuing it, he will be affected because, let's say that 100 naira now, you are bringing 75% of the money and your sister-in-law is bringing 25% of the money, and you have finished buying everything. 100 naira minus 80 naira is 20 naira goodwill. After buying everything, you now notice that there is a payment of 10 naira. Would you want to bear that impairment alone? The answer is no. The MCI, which is your sister-in-law, that brought 25 naira and you bought 75 naira, making it 100 naira you pay to the guy, the NCI will have to bear 25% of the 10 naira, while you also bear 75%, because nobody wants to feel cheated at all. Now, for the consolidated reserve, you would also take 75% of it, because it's like something don't spoil, so you just have to take it. IJ, tell me you understand. So if you don't, I have to use another illustration. Please tell me you understand, so that I wrap up this one. Okay, let's quickly go. Equity and liability. We take the parents' share only. The parents' share is only this 600. Share premium. Let me do this. Goodwill, NCI, consolidated reserves. Goodwill we have put here, you take it so you don't forget. So we have not put in the NCI yet. You take it one step at a time, slowly. So now you put consolidated reserves. What was our consolidated reserve? If you check what we did, it's 1145 from workings. We did this one. These were from our workings. Now we come here and put NCI. Now, these are where the thing comes under. Thank you. NCI from the workings 195. We take it. So you see, these workings which we have worked, we are just taking the things and just slotting it in. This is a hard work. And note something, you have to practice it over and over. It doesn't just come like that. Then what happens? The other one is current. Permit me to clean this. This is the consolidated reserve. You can see it's this. But I have to clean this so that I can continue here. Now we have trade payable. That's straight from the question. You don't need to do anything. All you need to do is your addition. That's 250 plus 100. Look at it down here in the question. 250 plus 100, that is 350. 250 plus 100, that is 350. Then we'll come here, S's books. 200 minus 200, that's the contra. The one we said contra. Then after adding all this up with your calculator, 600 plus 600 plus share premium 200. Straight from the question, 200 for the parents. 600 plus 200 plus 1145 plus 195 plus 250, 350, that gives us 2490. And this is the consolidated statement of financial position of Pole Group as at 31st December 2014. I would want you to try this question out again, because if you don't try it out again, you would not have, you think you understand now till you put your pen to paper. When you put your pen to paper, things will pop up to you. You begin to understand why you have to do things like for the retained earnings, why you have to do 200 minus 120, and it has to come to you quickly. It's not something you have to remember. You have to know that it's open up group accounts, 1, 2, group structure, 3, consolidation adjustment, then the big 3, goodwill, NCI, consolidated reserves. Blah. So based on that, we're done for this class today. Please do redo example 3 again on your own and example 4. The next time we meet, which should be on Thursday, let's meet on Thursday next week, unless I'll follow up on you ladies. Let's meet on Thursday next week. Work on example 3 and example 4. So if we meet on Thursday next week, we'll also meet on Saturday. So Thursday, Saturday, that's it. Thank you very much for your time, and it's a pleasure. Send me emails, call me when you look at anything you don't understand, and I'll explain personally. That's why I'm here for you. Thanks.